So good afternoon, everybody. I really want to thank everybody for joining us today for our First-Time Homebuyers Webinar. My name is Carla Giacomini. I'm Director of Digital Marketing here at Alterna. I'm really excited to be hosting this webinar today. We are going to, you're probably seeing on the screen, our home buying. We're going to cover a few things off today. Our mobile mortgage advisors are going to take you through what the Alterna difference is. They'll be talking about home trends for 2023. And they're going to take you through everything you need to know about buying a home, that whole journey. So before we get started and get into the webinar, I just wanted to take care of a couple of things so everybody is aware. Everybody, the participants, will be in listen-only mode. You'll be able to ask questions during the webinar in the chat function. So please type in your questions in the chat, and we will try to get to them all. If we run out of time and we don't get to your question in today's session, we will definitely get back to you by follow-up on an email and be sure that we answer that. Also, we are, as I said, it's going to be recorded. Also, if you do have to drop off early or what have you, we will be sending out a link of the recording later on with a survey. Okay, so now I wanted to get right into it. I wanted to present our mobile mortgage advisors, our experts. Jessica Bird, she's been serving the Greater Toronto Area for over 16 years, and Katie Gordon, who has served Otto's West End for over 10 years. And both Jessica and Katie, they both provide personalized advice and solutions to make your homeownership goals a reality. So right now, I will turn it over to Jessica, who's going to start us off to talk a little about the Alterna difference and some of the trends. Over to you, Jessica.
Thanks, Carla. Welcome, everyone. Like Carla, I'm Jessica. I'm covering the GTA and surrounding areas for Alterna for mortgages. So we're just going to get into it. What's the difference between credit unions and banks? So there is some great differences. Alterna is one of the oldest credit unions, so that's we have a lot of backing with that. We offer a lot of everything that the banks do also. We just do it a little bit better. From checkings to savings accounts, mortgages, personal loans, and more. We have an outstanding team of wealth advisors and us mortgage advisors. We help members to plan retirement, home buying, and other financial goals. This chart does a quick comparison between banks and credit unions, just for a quick reference. Credit unions, we are owned by our members, and all profits go back to our members for the betterment of our products and services. We are proud of the more personalized service we offer to our members. We typically have lower fees, very competitive rates, and we invest in our communities extensively. You should also note that through the exchange network of credit unions that we have, the largest ATM network that is surcharge fee across Canada. So you will likely never pay a surcharge fee if you bank with us. Our ATM network is the largest of all of the banks. So as I mentioned in this slide, on to the next. As I mentioned with the last slide, we do like to say we are a little bit better than the banks because we do personalize for you and tailor to your services very specifically to our members. We give you good and honest advice. Some of you would be surprised, but we've been around for 110 years. Most people who hear of us, it's for the first time and ask if we're new, but we're really not. We are one of the oldest and largest credit unions in Ontario, like I said, and credit unions are a very well kept secret. We are created differently than banks, which means we operate differently and we have values that are just a little bit different. You will get to know when you become a member with us if you're new. This slide here covers a lot of a screenshot of our products. Like I said, again, checking and savings, a lot of our wealth management advisors are mobile as well too. Mortgages and loans and everything you can do at a bank, you can do at a credit union as well. So what is happening with the real estate market for this year, 2023? So Bank of Canada, a lot of you have probably heard, raised their rates many times last year. What does this mean for mortgage lending? It means variable mortgages and home lines of credit, rates and payments increased. While fixed mortgages did remain the same, but for their future renewals coming up soon, they will reflect the new rates and will go up also. Along with the Bank of Canada increases, the posted fixed mortgage rates increased alongside, as have been reflected for the last year or so. Thus, increasing the stress test rate to qualify for a mortgage is a little bit harder. The stress test was put into place by the Canadian government to safeguard mortgage lending on an income to debt ratio. So this is really assuring Canadians that they're not overextending themselves. However, the positive of these changes is that it allowed the market to balance out and shifted home prices down to more true values. So there's that bubble is slowly going away. So let's look at some comparisons on the next slide. Home prices came down 16% last year in 2022, mostly a result of the Bank of Canada rate increases. This helps with more affordability with those looking to purchase their home this year in 2023. You can see the slight decrease in detached homes, but the most difference seen is in condo prices, specifically geared towards the GTA core area. It rose 24% back in 2019 when the market was crazy, and then came back down 20% in so far this year in 2023, which is great. This is allowing condo sales to rise a lot this year. With the two main changes in real estate, market being the stress test and the increase of Bank of Canada rates, the market is slowly returning back to the normal housing environment, which is really good news for everyone looking to get into the market this year. And we don't anticipate any changes or a lot of changes this year for the stress test and or the Bank of Canada rates, which is great news. Also, the national trends for 2023, as you can see a little snapshot here. For those looking to buy a home, again, the all-time high was last year, February 22, but we have seen the decrease of 18% so far this February of this year, which is really great news for people. With the increase of the rates in last year, they went up. The prime rate went from 2.7% up to 6.7%, all in last year alone. That were the increases for the Bank of Canada rates. This made it more expensive for current home buyers, but for buyers, and the qualifying process was a little bit tougher also. It made it a little harder to qualify for higher amounts, but this does leave Canadians with a little bit of work around how to afford, multi ownership and whatnot, but we'll get into that on another slide. I'm just gonna turn it over to Katie.
Thanks, Jessica. Hi, everybody. Welcome. So as Jessica mentioned, we've seen a decrease in the purchase price on average in Ottawa and Toronto markets overall. And it's, a good opportunity to assess your situation and determine, whether it's worthwhile for you to continue to rent or to move forward in an owning capacity. So there's lots of arguments and considerations for and against each. Some of the pros on renting could be your same monthly payment. So, you have predictability of your expenses, living, within, a possibly a more modest budget by renting. It's great for short-term or temporary accommodations. And the landlords are the ones that handle the repairs and cover the expenses of the property. So, you don't have to make sure that you're setting money aside each month for those types of things. On the other hand, there's definitely arguments for owning. You have a stronger sense of stability, given that you're in a longer term, committed residence with a community surrounding. You would month over month be paying down your mortgage, which would help build equity in the home. And as we've seen, with the markets overall, you typically have a positive increase to your property value. So there's twofold there for building equity. And in general, it's proven to show that owning is very often better, from an investment perspective. So, renting versus owning, there are pros to each. Contrary, there's also cons. Renting is, often difficult when you're not able to make renovations or personalized customizations to the space. For someone who enjoys home decor, you don't want to necessarily invest a lot of your own money into somebody else's property. And then you may be forced to move, based on if the landlord is deciding to sell and possibly the new owners are moving in to occupy the residence themselves. You could be forced out of the rental property, and which could be costly and inefficient for you. And there's also cons to owning a property. We can't always predict what our housing expenses are month over month. These vary, depending on the condition of the home. And the state of the economy. We've seen with inflation, causing an increase in our utility costs, things like that. And there's other financial obligations. You have property taxes, you are tying up potentially, money in a down payment that you could possibly use to invest in other ways. So there's, lots of costs around, and benefits and pros to each. And you really have to sit down and determine what is going to work for you. Now, on our next discussion about costs of home ownership specifically, there's obviously ongoing costs, including, taxes, maintenance, things like that. And there's also costs involved on closing that have to be considered. Normally, we would typically require you to have 1.5% of the purchase price of the property set aside for your closing costs, so that, when it comes time to receiving that invoice from your lawyer or from, the home inspection, that you have money set aside from there. By planning and ensuring that you have those closing costs set aside well ahead of your beginning of your process, it will be less stressful and better prepare yourself for the pre-approval or the offer to purchase. And one benefit that Alterna offers is an incentive cash on closing. We can offer you up to $1,000, which will help offset some of these closing costs that you may have. So I encourage you all to speak with Jessica and I about that after the seminar today, and we'll be able to tell you exactly what you would qualify for in terms of an incentive amount. The next subject we're going to talk about is really determining if you are ready. Are you ready to take the plunge to move out of a rental or from your parents and buy a home all to yourself or possibly with somebody else? So the first step is really meeting with a mortgage advisor to determine what can you afford to spend on a first home. We would complete a debt servicing analysis based on your income in a stress test scenario, like Jessica had mentioned. And we would determine, what comfortably you are going to be able to afford in terms of a mortgage payment, considering taxes, utilities, things like that. The second point that we need to consider is your down payment. Have you saved enough to put your down payment against your first home? The minimum requirement is 5%, and we'll talk a little bit more about that later. But it's important that you have a savings plan in place so that you're able to save at least 5% down payment for your first home. Third and fourth points are kind of combined, but they are revolving around your credit history or your credit score. Do you have an established credit history, and do you know what your credit score is? One of the key items that the credit union prides ourselves in is ensuring that we help you to establish a strong credit score at all points in your life. So we will sit with you at least once a year and pull your credit report free of charge. and we will discuss points and make recommendations on what you can do to help improve your credit score. And lastly, do you have a handle on your debts? You know, are you paying yourself in a savings capacity? Are you making more than the minimum payments on your credit cards and lines of credits? All of these factors will come into play with your budget and your overall financial health, which is going to be crucial in determining your mortgage qualification. Moving on to the next slide, we'll talk a little bit about the down payment. So as mentioned previously, the minimum down payment is going to be either 5% in a high ratio mortgage or 20% in a conventional mortgage. But what is a down payment exactly? So the down payment is the portion of the home price rather, that is not financed through a mortgage. So this is your initial cash outlay to make the transaction work. It's dependent on, you know, your financial picture, on your ability to save in the longer or short term, and cash flow. So do you have enough money at the beginning or the end of each month to set aside for your down payment? There are minimum requirements. For properties under 500,000, the minimum down payment would be 5%, which essentially requires you to have a high ratio mortgage where there's mortgage insurance applied and added to your mortgage. On the other side, the 20% conventional mortgage essentially is when you would have a minimum down payment of 20% or more of the purchase price. There are benefits and costs to both. So again, speaking with your advisor, we will go through the process of determining, you know, what is a better fit for you. The next topic is specifically around mortgage insurance. So what is mortgage insurance? It's not to be confused with creditor insurance, which is a product often offered by mortgage lenders, and the coverage would pay for the mortgage in the event that you were to pass away or something were to happen to you. This is not the same product. This is mortgage insurance is essentially default insurance that protects the lender in the event that the borrower is not able to pay their mortgage. So it is a requirement for all mortgages with down payments of less than 20%, and it's a premium that's added to the mortgage. You're not paying this out of pocket, but you are paying it month over month through the amortization of the mortgage. It's insurance that's typically required for mortgages with a loan to value ratio of more than 80%. So we will, you know, work with you to determine which mortgage insurer is a good fit. Alterna often will utilize CMHC and or Sagen as examples for our mortgage insurance providers. Over to Jessica to talk about saving for your down payment.
Thanks, Katie. So this is it's a great topic. How are ways to save for your down payment? I would say to start at the very beginning, start with a budget. Write down all your expenses, all your sources of income, research, look at some homes. There's a great app called realtor.ca. I'm on it all the time, even though I'm not looking for a current home, but it's always interesting to go through and see, you know, what kind of condo you like, what kind of house, see what the values are. Look at examples of property tax amounts, condo fees amounts, put those into your budget. Maybe do a simple calculation of what your mortgage would be. That's definitely something you could do with your mortgage advisor to get a more certain look at what your mortgage would be for a payment, as you still have to pick between high ratio and conventional based on your down payment amount. Also, to make your budget, it's always good to add in anything like your subscriptions that you have on a monthly basis, all of your habits. Maybe take a little look at those and see how you can cut back maybe a little bit, and you can add that to more of a savings. When it comes to savings, you have many products that you can choose from. So there's short-term, high-interest GICs, savings accounts, tax-free savings accounts known as TFSAs. Also for a home buying down payment, it's also a really great option, your RSP, because it's a locked-in savings option. You can't take it back out for those people that aren't the best at budgeting. And also for your future, you as each borrower can use $35,000 towards your down payment. So that's penalty free. And also you have 17 years to repay that back to your RSP. So that gives you a good timeline, and you're not going to be stressed out having a new mortgage payment plus this huge repayment to your RSP. That 17 years really does take some stress off of you if you choose to do that. Also, when paying down your debts, it's always good to start with the higher interest credit cards maybe first, because you're paying more interest. Maybe put more payments towards those if you do have outstanding debts that you can't pay full on a monthly basis. And always make sure to pay your minimum payments per month, because this is going to keep up your credit score. And your credit score is very important when applying for a mortgage with us. So also evaluating all of your spending habits will also show you how much little money you can save on a monthly basis, and shuffle that into savings versus little spending here and there. So all of these play a really big factor on budget and your savings plan. We'll move over to the importance of pre-approvals. So this is very crucial. When completing your budget, always include your new mortgage payment amounts if you have one. And also, what is that comfortable mortgage payment amount in your budget? What are you comfortable with on a monthly basis? Have you added in those condo fees and example property taxes? Because those are very important, along with any unexpected expenses. You always want a little buffer as well. What does your interest rate look like? Have you picked a type of mortgage? Is it fixed, variable? We'll get into those a little bit more in the next slide. Is your mortgage going to be high ratio, conventional? I know Katie kind of touched base on those. High ratio is going to be any down payment less than 20%. And then conventional will be any down payment more than 20%. So this will play factor with the rate and the rate that you have on your mortgage, and will also affect the payment of your mortgage. All of these is where you'll be sitting affordability wise before looking at homes with your realtor. All right. So is your pre-approval a guaranteed mortgage? No. And there's a lot of confusion around this subject. A pre-approval uses example approximate purchase price. So you don't have a specific property we can use for the pre-approval. We're just using example purchase price, example property tax, and example condo fees. Those vary from building to building and can be very extensive in difference. It's always good practice to place an offer of conditional finance when you're buying a home. This just safeguards you in the case of any issues when you go to qualify for that specific property. Gives you a little bit of peace of mind too, especially for the first-time home buyers. That is all very new to you. The average timeline for this condition is about 5 business days. And if you have a full pre-approval with your mortgage advisor, this timeline shouldn't have any issues at all. Because the full pre-approval is when you submit your income documents, your down payment sources, whether it be your own sources or gift. You want to always put that up front and have them evaluated, and have your credit pulled and checked. And that way it gives your mortgage advisor a full picture of what you qualify, your qualifying criteria, and will allow them to give you your full maximum mortgage allowance. So when you go look at properties with your realtor, you have in hand, this is what I can afford, and we're not going to go above this amount. And I'm going to leave it to you, Katie, for the next slide.
Thanks, Jessica. So as Jessica mentioned, it's part of our process at Alterna to provide our anyone really who's interested in a mortgage, whether it be a purchase or a refinance, to provide a fully adjudicated pre-approval, which includes pulling a credit report. What is a credit score? So your credit score is given to us from Equifax or TransUnion, and it's your 3-digit number that is your prediction based on statistics of your credit risk or credit worthiness at that specific point in time. So the higher your score, the more likely you are to be approved for a mortgage, and often it can affect the interest rate. So we want to ensure that you're taking measures to ensure that you, one, know what your credit score is, and two, to address any concerns around what it may be if it's below what's required. The higher your score, the more likely you are to be approved. And there's different factors that go into what makes up a good credit score. We'll talk about that on the next slide specifically. So there's, various things that will affect your credit score. For example, what you owe on your credit card, how you pay your credit card, like Jessica had mentioned, always making an attempt to pay more than what's outstanding. So paying more than the minimum balance, paying it off in full each month if you can. How you pay. So do you pay on time? Are you late once in a while? Are you late all the time? All of these factors will determine your credit score. How much available credit is in use? So do you have multiple credit cards that you carry balances on? Do you have, perhaps a student loan or a car loan? How much debt overall do you have? And how old is that credit history? You'll want to keep, your very first credit card for as long as you can, forever if possible. The older your credit is, then it will impact a higher score for you. Inquiries. We always get questions around, inquiries and the effect of pulling a credit report for a mortgage pre-approval purpose and how it affects your credit score. Typically, it's not significant, 2 to 3 points per inquiry, and it would rebound after 1 to 2 months. So pulling a credit report for the purposes of completing a mortgage pre-approval is really not going to have a significant impact on your credit score. And a mix of credit types. So do you have revolving credit and installment credit? Are you familiar with the responsibilities around paying each? All of these factors will affect what your credit score is. And again, as a credit union, we make it our purpose and our job to help affect your credit score positively. So if you know what your credit score is and you're not happy with it, or if it's been a factor in your mortgage qualification, come and talk to us. We'll give you some advice and some tips on what you can do to help improve that. So overall, there's a few things that you can do on your own to improve your credit score. Clearly, making sense of it all would be paying your bills on time. Making your regular payments of at least the minimum required amount month over month, so that your creditors can establish that you are capable and responsible to pay your bills. Paying off or paying down your credit card balances. This is a big one. Like Jessica mentioned, it's very costly to leave a balance owing on a credit card. So you'll always want to pay the credit card off first over anything. Try and pay even more down if you can, knowing that you're going to use it in the future. You can order a copy of your credit report or use applications online, but you really want to make sure that your source of information is going to give you an accurate score. So Equifax or TransUnion are great examples of organizations that can provide you your true credit score. And work with us. Check with your credit union banker or your mortgage advisor, and we can determine what your credit score is by pulling your report. And then again, if there is mistakes on the report or if there's things that need to be corrected, we can help you contact the agency so that these are adjusted and completed for the future. Over to Jessica to talk about multi-ownership.
Thanks, Katie. So given the housing environment that we see now, with the stress test making it a little bit more difficult for the qualifying process, and then also the value of homes just being a lot more than what they used to be, it's always a nice option to have to add family, as in parents, as co-borrowers on your applications to help strengthen the lending allowance. So that's always an option, but everyone's application is very specific. So definitely talk to us if you have any questions about this. So there's two type of mortgages I kind of briefly mentioned before in the early slides, but the two are the fixed and the variable mortgages. The main difference between the two, I would say, is the fixed payment and amortization for your fixed mortgage. This is very helpful for someone that with a tight budget and no room for change. It just safeguards you from any changes within your term that you choose. And also your amortization is the lifespan of your mortgage. So there is a difference between term and amortization. The term is, say, your 5 or 2 year term and the rate that you choose for that term. And the amortization is the total lifespan of the mortgage. So that would be either 25 or 30-year amortization. So it's the variable mortgage rate can change the payment and the rate given the Bank of Canada changes their prime rate. So it's not a promised payment or rate. So if you have flexibility, that was always a very good option in the past. But right now, as it sits, the variable rate is actually higher than the fixed rate. So it's not very popular choice as it sits higher than the fixed, and there's not really any win-win with the variable at this moment. But that's the main pros and cons between the two different mortgages that we offer, the fixed and the variable. And that is it for our slides. Katie and myself have our scan codes at the bottom there if you wanted to book an appointment directly with us, if you had questions about today's show or slideshow, sorry. Also, the rates that we have are very competitive, and we do hold them for 120 days, which is very good in comparison to other financial institutions. And we do try to save you up to $1,000 in legal fees and appraisals. So that's always something we could talk about too. Katie?
Yes, that's exactly. I couldn't mimic it any better, Jessica. The scan codes will lead you directly to a link that where you can arrange to have a schedule appointments. So utilize those to book directly with us in our calendars. We would be happy to meet with all of you at some point in the near future. We are going to hand it over to Carla, who's going to field some questions for us.
Thank you, Katie and Jessica. That was great. We're going to jump into the questions on the chat, and we actually had a question, Katie, all around the credit score that you had talked about. One of the members is asking, they only have one credit card and one phone bill. Should they get another credit card?
Yes, absolutely. So most mortgage insurers and our prudent lending practices would recommend that all borrowers have minimum of 2 major trade lines. Often you'll see, like she had mentioned, the cell phones showing up on the credit report. It is not considered a main trade line. So there's various things that you can do. You can take out a small line of credit or overdraft, a second credit card, even an investment loan or line of credit would be a great way to start the process for completing a down payment savings plan and establishing your credit rating in a second trade line.
Perfect. Thank you, Katie. Jessica, we have one for you that is asking about switch. So they're saying, can you switch from a high ratio mortgage to a conventional mortgage at any point in time, and
Okay,
how?
so okay, thanks, Carla. So when you're in a high ratio mortgage, that's because you put less than 20% down on the home. Um, so it's going to stay high ratio until your loan to value of the home is 80% or lower. So in easier terms, if say you bought the home and you put down 5%, 5 years down the road, you reappraise the property and now the value has gone up and your mortgage has gone down. So now you own 80% or less. You own 80% or more of the property. You can switch. Your mortgage technically does go into conventional terms. So you don't need to switch the mortgage, but you do, after 80%, you can have the option of then maybe adding a home line of credit or refinancing. Katie, do you have anything else to maybe if I explain that right?
Yeah, no, that was a great explanation, Jessica. Often a high ratio mortgage, like a mortgage with high ratio insurance, will afford a member a lower interest rate. So we really want to try and retain that insurance on the mortgage as long as possible. So anything like a refinance would trigger losing the insurance on the mortgage, but a straight switch, and without changing the amortization, without changing the balance, we would still, move the mortgage, retaining the mortgage insurance on it to afford the member the lowest possible interest rate. That's all that I wanted to add. But no, you did great, Jessica.
Now one for Jessica. Any tips for saving for a down payment?
Budget is probably the number one. I think when I started in banking, this is probably one of the things that I learned off the hop, is on payday. You can open a bunch of different savings accounts and name them online. Your vet bill account, down payment account, vacation account. On payday, just have all these automatic pre-authorized payments go to these accounts, and it's just less thinking, and you don't have to worry about it every payday. And your money you're paying yourself first before, and then whatever's left over, that's when you allot the money to your credit payment. Your minimum, well, hopefully you're trying to pay off all of your balances on your debt monthly, but if you can't, you're paying as much as you can. But then that way you're safeguarding yourself. You're putting savings away to what you want. So I would say budget and pre-authorized payments are probably key factors in establishing a really great down payment.
Great, thanks, Jessica. Katie, another question came through. Is there a possibility to get a mortgage without a down payment?
Not any longer. No, those were the good old days. We do require a minimum of 5% down. It can be a gifted down payment, however. It doesn't have to be from your own saved sources, but there is a requirement now to have a 5% down payment with Alterna.
Okay, great. Thanks, Katie. Jessica, another one for you. A general question, like how much should you save for a down payment?
I guess the starting point is what is the value of the home that you want to buy. So say if it's a $500,000 condo that you're looking at, it would be 5% of that would be the minimum. And I would start at that. If you can do more than 5%, it's just going to lower your mortgage amount and lower your mortgage payment. So I would start with, the homes that you're looking at and work down from there. If that 5% is not attainable for you, then you would, start lowering the value of your purchase and work backwards that way.
Great, thanks, Jessica. Katie, there was one that's come in asking about the difference between high ratio mortgage and a conventional mortgage. What's the difference in the rates?
This is a tricky one to answer, only because the rates are constantly moving, especially these days. We're often, setting rates, and then within a week or so they're changing. But typically anywhere from 5 to 15 to 20 basis points is really the difference between high ratio and conventional mortgage rates. But again, I would recommend speaking with us, to determine what your rate would be. Again, this will determine, what you can afford based on your credit scores, and also what we have as an offering in the market of today. The rates are constantly changing, so come and speak to us, and we'll be able to get you a great rate.
Another one, since it was your area you talked about a bit, Katie, someone is asking, how much should they put aside for closing costs, and what types of closing costs can they expect?
This is a great question. So we need to, when we're qualifying a member on a pre-approval, we need to arrange to have them save 1.5% of the purchase price for closing costs. And this is a requirement that we're regulated on. So even if they are qualifying under a first-time home buyer and may not necessarily have to pay the full land transfer tax, we are still required to ensure that our borrowers have that money set aside so that there is sufficient funds on closing to make sure that the closing is smooth. So 1.5% of the purchase price is the rule of thumb. These would include things like land transfer tax is the major one, adjustment to property taxes, since the seller often would have prepaid their taxes for the year. It would also include your lawyer's legal and disbursement fees, things like that. This is on top of what your transactional costs would be to actually submit an offer. So you may have a status certificate. If you're purchasing a condo, there's a fee for that. There may be a home inspection. So, even before you've entered into a final agreement to purchase the home, you'll want to make sure you have at least about $1,000 to cover off status certificate, home inspection, things like that, and then your legal fees for closing.
Great, thanks. Thanks so much, Katie. Someone's looking for a little more information about the first home savings account and how it'll work.
Sure, I can speak to that. So the First Home Savings Account it's a hybrid account between the tax-free savings account and the RRSP home buyers plan. So essentially, there's a set amount of money that can be invested each year, would be $8,000 per year, up to $40,000 maximum, that can be used as a down payment against the purchase of a home. So essentially, you're benefiting from the tax incentive of making that contribution. And then also you're benefiting from the tax sheltering of the investment itself. So we don't currently we're working to arrange the tax-free savings account. So I would recommend you speaking with us in detail about that strategy, and we'll be able to assist you and guide you with that.
Okay, we have another question. I'm looking to get into the housing market, but don't know where to start.
I would say, sorry, Katie,
Go ahead, Jessica. Yeah.
I would say the first place to start would be to talk to a mobile mortgage advisor, like Katie and myself, and also bring along your budget that you did at home as much as you could on your own. Talk to us. We can go through your incomes, your debts, your credit, and give you a rough idea about where you can start. And then you can choose to do a full pre-approval at that point. I would definitely recommend to do the pre-approval before going to look at homes with a realtor, because you don't want to go out looking at homes that maybe out of your budget. And this way you have a more concentrated and direct into what you're looking for. So yes, I would say work on your pre-approval first, and then start looking at homes with your realtor. Katie, anything you want to add to that, or is that what
I
you?
think just, I mean, allotting a lot of time before you're planning to look at any homes, you have to prepare yourself. You want to definitely make sure that you are pre-approved before you even start engaging a realtor, because they're often going to ask you for that pre-approval letter. So, ensuring that you're starting, 2, 3, 4 months before you even are interested in looking at homes. Talk to your mortgage advisor so that everything is arranged and you're going about it in a in a comfortable, stress-free way.
Great. Thank you both. Someone is asking a question about, for new regulations about new immigrants to Canada in order to qualify to buy a home. Either of you want to jump on that one, or is that something we can maybe get back
I know
to
that they
the?
just recently changed it. So new immigrant. So with a PR card, there's all different types and different regulations. So it would be very specific to the person. Katie?
So, yeah, sorry, go ahead, Katie.
Yeah, I was just going to mimic that. And, we have several files that we have assisted in the financing of for new immigrants. So we do have the capacity and the ability to help members looking for mortgages in this circumstance. So yes, I would recommend them reaching out to us directly so that we can, get a clear understanding of what their financial picture looks like, and then give them some guidance from there accordingly.
Thanks. And I would, yes, encourage anybody that really wants to, has specific questions about their situation to contact either Katie or Jessica directly, and they can answer those specifics for sure. Okay, and another question, I'm wondering if I should continue to rent given the crazy housing market, or buy now so I avoid home prices that continue to go up. What do you think? What are you suggesting? Like based on the knowledge, your knowledge of the market.
I would say, well, Katie's is based in Ottawa, and I'm based in GTA area. I know a lot of people have heard about the rental amounts in the GTA specifically, and all over surrounding areas. Actually, I'm sure it's high in Ottawa as well. But I would probably start with a spreadsheet, a rental sheet, and an owning sheet, and work out both. Do scenarios for both. What is your typical rent that you're looking at, the units that you're specifically looking at? What are the rent ranges? Is that including utilities? Is that including anything else? And just have a budget for that, and then go over and see what your mortgage payment would be with the option of mortgage that would be specific to you. What are the property taxes amount? What are utilities for that? And is there condo fees that you're paying if you do purchase a home? So just do side by side and do both scenarios and see what works better for you, because every scenario is going to be different and every person's going to be different. So it's not a right or a wrong answer, and it doesn't mean it's bad to rent or it's better to own. That's not the case whatsoever. It's just what's better for you.
Kind of along the same lines, looking for some suggestions. Someone's asking, would it be better to wait until next year to purchase a home?
I can speak a little bit to this one. So I think it really comes down to, where you are at in terms of stability. Do you have a stable employment position where you can rely on for income? Are you able to get a mortgage pre-approval? You know, there's pros and cons to waiting, but at the same time, the market may go up by then, the rates may go down. It's kind of a mix of both, and they're moving contrary to one another, it seems. So you really have to, weigh, do you have a down payment saved? What is the opportunity cost of that down payment? And then determine from there, based on your overall financial health, are you in the position to hold a mortgage? And is it something that you're ready for from a longer term commitment? It's definitely more, there's more emotional attachment to owning your own home. And so you have to be prepared for that aspect of it as well.
Great.
I would
Thanks.
also, I just want
Sorry.
to, sorry, no, it's okay. I was just going to add too, we don't know if housing is going to go up or down. We've seen such a crazy turmoil in the last 5 years, both up and down. So to know if housing prices are going to go up or down next year, we don't know. But it's always one thing is home ownership is a long-term investment. So if you are to buy today or this year, your home equity is bound to go up in a longevity purpose. Like you're not just buying for 5 years, you're buying for probably a lifetime. And not specifically this home, but you'll be a homeowner for a lifetime. Usually once you start, you're there for a lifetime. So the equity is going to go up. It's always going to be a positive over time.
And we've got another question. Please explain getting a mortgage for a new condo building. The process, I guess, how is it different?
It is a little bit different because of the condo corporation registration requirement. What often will happen is, the condo building has to sell a certain capacity before they can register the condominium. So you may go into renting your unit. But essentially what we would do is we would pre-approve the mortgage and ensure that you're able to afford the purchase, and then closer to the closing date, determine what your rate would be based on the current rates at that time. Often these purchase agreements are 12 or 18 months out. So it's again a process that you're going to want to start early. Whenever you're starting to consider purchasing that condominium unit, you need to, before signing anything, you'll want to be pre-approved, pre-qualified, so that and have an understanding of what your affordability is. But we'll work with the condo builder to arrange the mortgage once the condominium is registered, and then we'll close the mortgage accordingly.
Great, thanks, Katie. And I think just one last question as we're coming up to the hour. Someone is wondering, like, when should I get my pre-approval? When within that mortgage home buying journey should I do that?
I would say that is probably your first stop, your first step before looking at homes with your realtor. So then you're prepared, and your realtor knows what he or she is going to be showing you, based on value, based on condo fee amounts, based on your affordability. So I would say probably at the very beginning of the process.
Anything else to add, Katie? Yep.
Just to add, to a comment that came out last week around an article about the emotional and physical and time investment that it takes to arrange a mortgage pre-approval and a final mortgage approval ultimately. You need to understand that we may ask for a lot of documents. It's just the reality of it. And you have to be, have some skin in the game and some collaboration with us to get it done. And so budgeting enough time and emotional, investment to complete it is really essential. And it will, it'll come back to you twofold, because one, you'll get your pre-approval in place, and then you'll build a great relationship with your mortgage advisor, so that when it does come time to moving it to a formal approval, it does go a lot more smooth. So just investing the time and the energy well ahead of the process would be all I would suggest.
Absolutely.
Great. Well, thank you both, Katie and Jessica. We didn't get to all of the questions, but as we promised, we definitely will get back to you with the answers to the questions that we were able to get to today. We're almost coming up to the hour, so we really want to thank everyone that joined us today online and your time to help allow us to talk about this subject, which both Katie and Jessica are very passionate about, for sure. Again, anything that is specific to your situation, feel free to contact either Katie and Jessica, and they'd be more than happy to answer really specific questions to your situation. You can scan the barcode on the screen, or their phone number and email are there as well. So again, just a couple of reminders before we close out today's session. We are going to send you a survey by email shortly that, will very short, just a few questions. We really just would love and appreciate your feedback so that we can make these sessions better every single time we do them. So we really want to find out what's important to you as we plan upcoming webinars for you. And also there will be a link to the recorded webinar if some people didn't have the chance to sit through the whole thing, or if there's some information you want to go back and look at, you'll have that as well. And that's basically it. So thanks again. I want to again thank everybody for joining, and thanks again to Jessica and Katie, and have a great rest of the day. Thanks all.
Thank you.
Thanks, everybody.